I have with me Louise Bedford from Trading Secrets and Michael Yardney from Metropole Property Strategists. Now we're going to be talking about property versus shares. Michael, thank you for coming in, Dollars with Sense.
Pleasure.
Louise, thank you.
Pleasure.
Now Michael, property versus shares. First of all, what is investing?
Well, I think investing is putting some money down to get a future better return. The problem that I see is most people who think they're investing aren't. They're speculating. They're doing it on hope rather than on proven systems that are trusted.
Louise, what's your opinion?
One of the things I think with investing is that a lot of people aren't setting themselves up as a small business from the very beginning. You know, there's a saying, start with the end in mind. So that if you want to develop a very big business, it's really important that you set yourself up professionally from the very beginning. They need to consider things like objectives, a trading plan, something that is going to guide them into the future. Their ingoings, their outgoings, they need to watch their costs. And I think that is really what investing is. It's setting yourself up in a small business, no matter which vehicle you choose, and making yourself into a better person because of it.
Dallas, it's the same with property. Most property investors don't get the success they hope for because they don't treat it like a business. I've seen that small group of investors who get it right treat their property investments like a business, with goals, with plans, with strategies, a finance strategy, a tax strategy and a property strategy, and then it works.
So you should be doing that with both shares and property?
Definitely.
Clearly.
Now, property versus shares. If I speak to you, Michael, you're going to say
Property's
property is
better.
number
Of
one.
course
If I
it is.
speak to Louise, Louise is going to say
Of course,
share trading
shares.
is number one. Now, Michael, beauty before age, so I'll start with you, of course. Why do you say property is best?
Because most Australians can become successful with property. If you see the way others have become successful and model them, you can find that the average Australian with an income and a bit of equity behind them can borrow money from the bank, and then the tax man helps you. They give you tax deductions, you can deduct the interest, you can get depreciation allowances, the tenant pays for part of your mortgage, so that makes it much easier. The other great thing I like about property is it's stable. It doesn't have the ups and downs that the share market has, and it's got a great proven long-term track record.
Well, you do say it has the ups and doesn't have the ups and downs, but I can see a few places overseas where it's had a few downs, but that's okay. Now, Louise, investing in shares, why do you say that shares are so fantastic?
Shares are clearly superior to property. There's so many reasons why. One of them is that you can actually get involved in property through shares. You can buy a property trust. So for a very small outlay, you can actually have all of the benefits of the property market. There's lots of other reasons as well. If you look at a lot of the independent reports that are written every year, they talk about who makes more money, the share people or the property people. Year after year, the Russell report comes out with equities as being the majority of the people making the money out of that. So it's clearly outperforming property.
Louise, in the Russell report, does it talk about who loses the most amount of money as well?
It doesn't actually.
It
It's
doesn't.
just comparing
Okay,
profit.
so it doesn't talk about the amount of money lost in shares or in property for that matter.
That's a fair comment because interestingly I found that 50% of investors who invest in property sell within 5 years. In fact, 20% sell in the first year, Dallas. So lots of people who get in property don't get it right either. That's why it's important to know what you're doing and do your homework and research. Educate yourself before you get into property or shares.
The timing, when should I be doing either?
Well, I think again it has to do with a plan. If you've got a plan and a strategy and you know where you're heading, then you've got to educate yourself first, then get sufficient money behind you, and when you're ready, I've found timing is not as important as many people think. Can I explain why? Really, I found some investors do well in good times and bad. You know, other people actually do poorly in good times and even worse in bad times. So it's not as much the timing of the cycle or the timing of the market, it's actually the success of the investor, their mindset and the way they treat things that decides whether they're successful in property. What about shares? Much the same?
With shares, I do think it is a timing issue. You know, a lot of people say it's not whether you're getting involved at all, it's when you actually time your entry and time your exit. There are cycles in the share market, but the good thing with the share market is you can make money whether the market is going up or down. There are ways to make money out of a downtrending market, so it does smooth your equity curve out. You'll make money whether it's going up, whether it's going down, and certainly with going sideways as well, which are the 3 cycles that the share market can go through.
Well, here's a question for both of you. I'm married, I've got a little bit of equity in my home and I'm contemplating investing. I don't know what to do. I don't know much about property. I don't know much about shares. I listen to the radio, read The Age, I think I'm an expert, but my wife thinks I'm not. What do I do?
I think that's a recipe for disaster, because if you don't know much about it, you're going to do what most people do and invest emotionally.
So how do I start my investing?
Educate yourself. There are some great books out there, there's some good courses, but be careful who you listen to, because at the moment there's lots of pretenders out again as the cycle moves on. So listen to somebody who's got a good track record and kept their wealth through a number of cycles. And if you're the smartest person in your team, you're in trouble, Dallas. So I'd get a good team of people around you, maybe a good financial planner, a good property strategist, an accountant who's not biased, people who are not biased, who haven't got a vested interest.
And when you're looking for somebody, I think it's really important when you're looking for a mentor to find people that they've helped. So find people with the track records for success for helping other people as well. I think that's one of the things that people do miss out on. It's not only longevity of the mentor, but it's also how successful they've been in helping other people.
Now, Michael, you've obviously got an investment portfolio, yes?
Definitely.
Louise, you've got an investment portfolio?
Yes.
So both of you are teaching these sorts of things to people, are you?
Definitely.
So if I have a handful of properties, I should be looking at shares for diversification. If I've got X $100,000 worth of shares, I should be looking at property.
I agree with you. It's not property or shares. I think there's room for both, because they have different cycles and they have different advantages and disadvantages.
I think also in relation to this, it depends on your level of equity in the beginning. Like for property, you need a fair bit of equity to be able to get going. Whereas with shares, you can start out with a smaller, more modest equity level, say $15,000. So one of the things I think that's really important to do is that you find something you have an affinity with. If you like property, then head for that. If you like shares, then educate yourself about that and see where that ends up going for you.
If I come to you with $50,000, Michael, what sort of property can I buy? To what level?
I think people should be buying the best property they can afford, and it's actually not a big block of land or a big property. I'd buy in the best area. So what you first of all got to do is see how much you can borrow, because $50,000 could be 5 or 10% deposit and the banks could lend you the rest. And if you buy an investment, then you'd be able to get probably a one-bedroom apartment in one of our good suburbs near one of the big capital cities. I'd rather buy a one-bedroom close to a capital city than a bigger property way out in the sticks, which won't go up as much in value.
Now, Michael, if I've got $50,000 and I want to invest in a property, what do I do from there?
Well, the first thing you do is get some finance. So go to your bank or go to a proficient mortgage broker and see how much you can borrow. That depends upon how much money you've got and your serviceability, how much you earn. Often they'll lend you another $450,000, which means you could leverage your money and buy a much, much bigger property. That's one of the benefits of property. And so you could probably buy a $450,000, $500,000 property, as long as you don't get yourself into too much debt. That's why you need a good broker who can show you how much you're going to be out of pocket each month, just to make sure you can handle the property.
So, Michael, what you're saying is the banks will let me borrow up to 90%?
That's a great thing. So it's actually not just the return on the total property value, the return on your money gets magnified considerably.
Louise, I go to your banker and I want to borrow to do some share trading, and I've got my $50,000. How much is the bank going to let me borrow with $50,000?
First of all though, Dallas, before you borrowed that money, I'd find out your background and find out whether you're already a proficient trader. I think people do borrow too quickly. Margin loans and using leverage through options and CFDs, it's definitely not the way to go if you're just starting out.
I've got the cash, I've saved up.
Have you got the education?
Well, I've come to you and I've got the education, and you're going to refer me to a lender because I've done one of your courses and I'm ready to go. I've got $50,000, I've walked into the local bank and I want to trade shares. What are they going to lend me?
I wouldn't actually go to your bank for getting a loan to trade shares. What I'd do is I'd use CFDs.
And what's a CFD?
CFDs are contracts for difference. Mm-hmm. So you can leverage those up to the hilt if you like. You can put in $10,000 and they can give you up to $100,000 in leverage. But the first thing that I'd do is I'd make sure that you were safely investing for at least a year.
So what you're
saying
saying
at least 12 months.
If I have $50,000, I can get how much are you saying to trade?
You could get up to $500,000.
Of $50,000?
Yes.
So they're going to give me on what surety? I've just got 50,000.
The difficulty with leverage is it's a twin-edged sword. If you're making money, it will magnify your gains. But if you're losing money, it will also magnify your losses. So you could actually end up owing the CFD provider money.
But I've only got 50,000. Are they going to allow that to happen?
They will allow that to happen because they'll take everything that they can as a surety. So they'll take a house or something
Well,
else.
I've only got 50,000. Here's my 50, that's all I've got.
I wouldn't do it. I would not do it. I would say that would be the easiest way to go broke in the share market, applying leverage too soon. Novices are attracted to leverage like moths to the flame.
Yes.
It's just not the way to go. Trade easily and securely for at least a year. Make sure you've got your training wheels on and then move into leverage.
So it's pretty simple. Before you even start contemplating investing into shares, invest into your education first.
Definitely, and also make sure that you've got at least 12 months of making profits in the share market before you actually move into any leveraged instrument or tool at all.
Now, Michael, how do I get an education in the property industry?
Well, it's interesting because there's lots of theories. One group of people say you should buy cash flow positive properties, and another group of people say you should buy capital growth properties. So already there's a diversity. And I guess it depends what level you come in at. If you don't have much money, people often need cash flow properties to start, but proficient investors, once you get to the next level, buy capital growth properties. So find somebody who's done it before you, who's achieved the results you want to achieve, read their books, go to their seminars, go on their websites, and get yourself a good mentor.
Where do I get a cash flow positive property in Australia?
I don't think there are many good ones around, and I know people will tell you there are, but they're in secondary areas. You see, in
What's
Australia...
the secondary area?
Well, in Australia, well-located properties are high-growth properties. To me, residential real estate is a high-growth, low-yield investment.
Michael, what sort of other property is there? You've got residential, what else?
Well, you've got commercial, you've got industrial, and there's property trust, so you can actually invest in properties through shares.
So you've got rural, retail, residential.
There's a whole group of properties, but for investment purposes, for the average Australian, residential property in one of our big metropolises makes the best, safest investment. The others fluctuate in value.
Why is that though? Why do you say that?
Well, because what pushes up property values is supply and demand. You need a wide demographic of people, of owner-occupiers in particular, to push up the value of properties, plus a scarcity. There's no scarcity in the outback parts of Australia. There's no scarcity in some of the mining towns, while there is in the inner suburban areas of our big capital cities.
Well, there's no scarcity in America either, and that's plummeted.
There is no. The problem is there's no scarcity. That's why properties have dropped, because they've built too many properties. If you open up the Saturday morning papers at the moment, I'm a bit concerned with all the new off-the-plan properties. If you look at our CBDs, we're going to have problems in a couple of years' time if all those projects come on stream. So what you've got to look for is the sort of property that's going to be in continuous strong demand by owner-occupiers, not by investors, because 70% of properties are the sort that are purchased by owner-occupiers. They're the ones that basically drive our markets.
How do I invest into property and have somebody as an owner-occupier?
No, you want the sort of property that a tenant will buy, but my twist on it, which is different to what most people do, is I look for properties that will be liked by owner-occupiers. So when a valuer comes around and values the property, he'll think, hey, if this doesn't work out, the bank will always get their money because there's a heap of people who are going to come to the auction and buy it.
Louise, how should I start trading? What sort of things should I be looking at doing to make some money out of it? I hear the property side of it and I understand how that goes. What should I be doing? I've got my money and I want to start. What should I do first?
Firstly, take a deep breath, Dallas, because it's sounding like you're very, very eager. Yes, I like that about you, I do.
I want to make some money. I've got the two of you here and I want to make some money, damn it.
The first thing I'd do is be looking at, firstly, your own education. Look at good books. Look at people that you relate with as an author. Then also find out whether there's any free information you can get your hands on. So there's things like e-courses, webcasts, things like that to be able to help you. You need a charting package, you need charting software. So you'll need a little bit of a learning curve to be able to get your head around that. And you really need to get some of the principles of trading down. One of them is that the trend is your friend, that you always buy into uptrending markets.
Is it stop losses?
Goodness no. Buying is different from stops. Yes, yes. So what we're looking to do is to, when it's going up, we buy it. When it's going down, we sell it. and we keep our position sizes small. So they're the 3 golden rules of trading. So with stop losses, I'll get back to your question with that. Stop losses are a terrific way that they're better than the property market, because if the market's going down with shares, you can actually exit, and you can exit easily. And usually people are trading things with enough liquidity so they can get out straight away. There's no delay. And that's really important too with the share market.
Louise, thank you for coming in. Michael, thank you for coming in.
Can I leave you with one last thought?
You can very quickly.
Because you were urgent about earning money. Wealth is the transfer of money from the impatient to the patient.
Very good, Michael. Thank you. Thank you for the 2 of you coming in.
Pleasure.
Well, there you have it. Louise Bedford from Trading Secrets, Michael Yardney from Metropole Property Strategists on property versus shares. Now go on to our website and have a look under guest profiles. Both Louise and Michael will have a few frequently asked questions there. Have a look at them. We're not saying they're both perfect, but it's a good place to start. If you like them, do something. If you don't, find somebody else. But for goodness sake, do something. Thanks for watching Dollars with Sense.